Hello everyone and welcome back. If you are a real estate investor, today's topic is a big one for you. This one alone can change how much tax you pay by tens of thousands of dollars. And yet a lot of people still misunderstand this topic completely. Today we are talking about real estate professional status and what IRS looks for. If you spend any time around real estate investors, you have probably heard someone say something like, just qualify as a real estate professional and write everything off. And I wish that was that simple, because what I see all the time is people hearing about the strategy and then doing it very wrong. And when it's done wrong, the IRS doesn't just say, oops, they just disallow the losses and penalties and interest. And suddenly the huge tax benefit turns into a very expensive mistake. So today I want to walk you through what this status actually is, who it's really meant for, and what the IRS cares about when they look at it. And by the way, we also created a simple checklist that you can use to see if you might qualify. If you want the spreadsheet, this checklist, just grab it below the video or in the link in the description, or even if you're watching on replay, type checklist and I will send it your way. Okay, so let's talk about why this status even matters. So today, as I mentioned, I will walk you through what real estate professional status actually is, who it's meant for, and what IRS cares about when they look at it. Normally, rental real estate is considered passive by the IRS, and passive losses limited, which basically means if your property shows a loss on a paper, maybe because of the depreciation, you often cannot use that loss to offset your other income. So if you're a high earner, maybe you're making 300,000 or 500,000 or 700,000 from your business or your job as W2, those real estate losses often just sit there unused and not helping you with your other, reducing your other income. They get suspended and carried forward, but real estate professional status changes this game. If you legitimately qualify, your rental activities can become non-passive. And that means those losses can offset your other income. That's why this strategy is so powerful. Suddenly, depreciation, cost segregation, and other real estate deductions can actually reduce taxes on your active income, such as W2 job or business that you have, in addition to your real estate. But here is the key. The IRS doesn't hand this status out easily, and there are two main tests, and both have to be met. The first one is 750-hour rule. You must spend more than 750 hours during the year materially participating in real estate activities. These activities must be real estate trades or businesses like development, construction, property management, leasing, brokerage, and things like that. Now, 750 hours sounds like a lot, but it's actually only 15 hours per week. So for many people who are actually involved in the real estate business, it's very achievable. This is where things get interesting. If you have a full-time job, W2 job, working 2,000 hours per year, it becomes extremely difficult to meet these requirements, because now you would need more than 2,000 hours in real estate to pass that. More than half of your total working time for the year must be in real estate activities. That's the second test. Again, more than half of your total working time for the year must be in real estate activities. And again, if you have already 2,000 hours for your W2 job, you need to have more than 2,000 hours in your real estate activities to have that real estate professional status. So that's where it becomes very difficult. And that's why very often in married couples, one spouse qualifies instead of both. While one spouse works W2 job, the other one does real estate and doesn't have to meet this second requirement of more than half of your total working time for the year must be in real estate activity. For example, maybe one spouse runs the main business or works a demanding job while the other spouse manages the real estate portfolio. The IRS allows you to count the hours of one spouse to qualify the entire tax return. This is one of the most common and most powerful ways this strategy is used correctly. Now, let's talk about something the IRS really cares about: documentation. Because when the IRS audits real estate professional status cases, the biggest issue usually isn't whether someone worked hard, it's whether they can prove it. The IRS wants to see a reasonable time log showing what activities you performed and roughly how much time you spend. This doesn't need to be some complicated system, but if someone says they worked 1,200 hours in real estate and has zero records, that's where the problem starts. Things like reviewing financials, coordinating repairs, communicating with property managers, overseeing renovations, managing tenants, researching new acquisitions, those all counts toward real estate professional status hours. Driving by your property once in a while doesn't count. Another area where people make mistakes is grouping election. If you own multiple rental properties, please listen carefully. This is an important point. You usually want to treat them as one combined activity for purposes of material participation rules. Without that election, each property may be tested separately, which makes qualifying much harder. This is a technical detail that many investors miss, and it can make a huge difference. If you didn't make the grouping election, you need 750 hours for each real estate entity, as opposed to if you do make this election and you have 3 entities, you can only have 750 hours combined for all 3 entities. And here is something important I always tell people: real estate professional status is not a magic trick. It's a powerful tax strategy when it reflects the reality of how you are operating your real estate business. But trying to force it when the facts don't support it is where people get into trouble. Done right, though, it can unlock massive tax benefits, especially when combined with strategies like cost segregation, short-term rental rules, and smart depreciation planning. That's why understanding it properly matters. So if you're a real estate investor and you've heard about the strategy but weren't sure whether it applies to you, grab the checklist we created for this video. It walks you through the key questions you can ask, you can evaluate, and start evaluating whether real estate professional status might actually fit your situation. And if you found this helpful, share it with another real estate investor who keeps hearing about huge write-offs but hasn't been told how it actually works. Because the goal isn't just to save taxes one year. The goal is building a real strategy that works year after year. All right, that's it for today. Thanks for spending a few minutes with me, and I will see you in the next live. And have a great day.